Hello, and thank you for joining us this afternoon for What the One Big Beautiful Bill Act Means for Nonprofits, hosted by Dean Dorton. Presenting today, we have Brian Pouch, Tax Director, and Jacob McDonald, Tax Senior Manager here at Dean Dorton. During today's session, we do have a Q&A feature that you can use. It's located at the top of the screen. All questions will be answered at the end of the webinar. This session does qualify for 1 hour of CPE credit. If you will, go ahead and scan the QR code that is located on the screen. It will prompt you to insert your name and email address. From there, you will be able to participate by utilizing the code words and inputting them during the session. We say code words, but they are actually code numbers, so don't let that catch you off guard. There will be 3 code words during the session. You must enter all 3 to be eligible for CPE credit. Our team here at Dean Dorton will issue the CPE certificates within 2 weeks of this session, and you will receive this slide deck along with the recording at the end of the session. I'll give folks just a couple more minutes to join before I hand it over to our wonderful presenters today. All right, it does look like we have a pretty full house, so I'll go ahead and hand it over to Brian and Jake. You guys feel free to take it away.
My name is Brian Pouch. I'm a tax director here at Dean Dorton. I head up the nonprofit tax area. Prior to joining Dean Dorton, I was the partner in charge of a top 30 CPA firm in the nonprofit tax area. I work solely in the nonprofit area. So year round, all I do is nonprofit tax work. During the presentation, I'll be talking about some of the individual tax provisions that are out there. Feel free to ask questions about those. I will not be able to answer them, but we do have a lot of people here at Dean Dorton who are very smart and would be able to answer those questions. So I'll turn it over to you, Jake.
Hi, I'm Jake McDonald. I'm a tax senior manager here at Dean Dorton. Like Brian, I focus exclusively on nonprofit organizations year-round. Before I joined the firm in May, I spent 19 years with the IRS tax-exempt and government entities division. Most of my time was spent on exempt organizations determinations, which involved rulings related to obtaining and maintaining tax-exempt status, including initial determinations, reinstatement of tax-exempt status following automatic revocation, and miscellaneous determinations like advance approval of individual grant procedures and set-asides for private foundations. My last few years were devoted to planning and monitoring examinations of exempt orgs. And we'll actually talk about a few of those today. It's a pleasure to be here with you.
Yeah, we would like to thank everybody for attending the seminar. Today we'll be talking about the One Big Beautiful Bill Act. I heard somebody call it the OB3A or OB3 Act, which is kind of catchy. But we'll talk about how that act actually specifically addresses tax-exempt organizations and then also how it indirectly affects tax-exempt organizations. Sarah, next slide. Today, the agenda that we'll be talking about is the background of the recent tax legislation that's out there, and we'll talk about the other aspects that actually affects it, which is the employer retention credit, the new Form 1099 reporting requirements, the college and university increased endowment tax, the excess compensation tax expansion, basically expanding the number of covered employees that are part of or subject to it. And then we'll switch gears a little bit and talk about the charitable contribution deductions for itemizers and non-itemizers and the charitable deductions for corporations. These are the kind of the provisions that are out there that indirectly affect charitable organizations. And then we'll wrap it up with the scholarship tax credit. Next slide. Next one. Basically, what is the big, beautiful, one big, beautiful bill? It is basically an extension of the Tax Cuts and Jobs Act in 2017. That was signed by President Trump back in 2017, and it included many different tax cuts for businesses and individuals. And at the end of 2025, all those tax cuts were going to reverse back to the 2016 law, and we expected to have large tax increases on a going forward basis. But that has now changed. A lot of the provisions are, in fact, have been extended and passed. I can remember, did I do something? I'm missing this. We're missing the slides. Sarah, do we have the slides? Okay. Could we go to the previous slide, sir? I'm sorry, I kind of messed something up.
Sure, you're all good.
Okay. And then the next one. Basically, if you take a look at it, when the Tax Cuts and Jobs Act came out in 2017, I can remember back then in 2018, I probably did about 15 to 20 different presentations to different charitable organizations, the donors, community foundations, alumni associations of different colleges and universities, all in regard to what does that mean now on the new tax law as to what does that mean in regard to our charitable giving? How is our charitable giving programs as a charitable organization going to be affected by the new tax law? And that was back in 2018. Same thing is happening right now. In 2025 now, we are going to be having a new tax law that's going to affect the future years. This is, again, a time when you look at it and you say, this is the time that we need to revisit ourselves as charitable organizations and understand a little bit about what this new tax law is and how it's going to affect charitable giving. Because if you look at it, charitable giving is probably the largest portion of your overall revenue as a charitable organization, or a very big part of it. So it's very important to understand what is going to be motivating donors to go ahead and make that deduction if there's any benefit for them. I do know over the years that I've been practicing that there are a lot of people, and most of the people give money not just because of the tax breaks, it's because they want to. And that's the things that you guys do as an exempt organization that really can, really motivate the donor to give. What the new tax law does is, or anytime there's a new tax law, it gives you that little advantage that you can be able to talk to your donors again, to touch base with them again, and let them know that you care about them. And here is some new information about the tax law. So this has happened back in 2018. We're going to be going through the same process this year, and it might be a very good situation. As we go through the presentation about charitable giving, we'll talk a little bit about the different types of things that you could do as a charitable organization to notify your donor base of the potential charitable deductions that they can get. And if you look at it in July 4th, of course, the Independence Day, that's when President Trump signed it. He signed the bill. We go to the next slide. And again, they made a lot of the tax cuts back in 2017 permanent. And they did have significant changes. If you look at the bill, it's a very large bill in regard to number of pages and the number of changes that they made. What we're going to focus on today is just the ones that affect tax-exempt organizations. Some of the individual ones, again, just because, again, I don't practice in the individual area, but I do practice in the tax-exempt area. So I do care when advising clients as to what they could do differently in regard to their charitable giving programs to actually increase it. One of the things you look at it, the tax rates between 2025 and 2026 are not going to change. Those tax brackets are going to stay, and they are permanent. So there won't be a game in that's really played to say, well, the tax rates, if you look at this Tax Jobs Act didn't pass, the new tax law didn't pass, and we're going back to the 2016 rules. I can tell you that what we'd be telling people is defer your deductions. Don't do it in 25. Do it in 26 because it'll be worth a lot more. Next slide. The standard deduction, if you look at that, back in 2016 was probably about 12,600 for joint filers. It's now 31,500, and this is now going to be permanent and will be indexed for inflation. For joint single filers, it was 6,300, and now it's 15,750. Plus, there's an additional $6,000 deduction for seniors age 65 or more with income at $75,000, and then it's phased out up to, I think, 150 or something in that regard. That 6,000 deduction will be phased out, and if it's both husband and wife are over 65, that would be $12,000. So you can see really what's happening potentially is that there's going to be a larger standard deduction. It stays the same for stays the same in regard to the permanency of the standard deduction, but now there's a senior deduction even more. So the first thing that comes to mind when you're looking at your charitable giving programs and you see that, you would say qualified charitable distributions, the QCDs. Those rules are extremely important and would be very, very beneficial for any senior over 70 and a half who is receiving a standard deduction of already 31,500 for their joint filing of the return, plus another 12,000. They're not probably going to be able to get a deduction for their contribution. But if you tell them to make sure that they do it through the QCD, they'll be able to reduce their overall income. And there's a lot of benefits for doing that. The personal exemptions, because of the increased standard deduction, was eliminated. That's permanently gone. Next slide. And then we'll talk a little bit about the SALT deduction. That's one that more people will be able to itemize. And that is that their SALT deductions will be increased from $10,000 to $40,000, and there'll be a 1% increase through 29. In 2030, it reverts back to 10%. I can say what happens this year, and it's more difficult. There's more complexity in regard to charitable giving this year. We'll be going over some of the provisions about a charitable floor that will affect the deductions people are getting. Next slide. Estate tax exclusion. That's at stays at 13,000. Approximately $14 million, and in 2026, it's going to be $15 million per taxpayer. So husband or wife, it'll be double the amount, 30,000. Again, from a state standpoint, and you're looking at individuals who want to give money, at their death, that it's always beneficial to at least inform them through your deferred giving program to let them know that you donate assets or you gift assets to your children, and the income aspects, the IRAs, the charitable IRAs, and the qualified plan money, that would be donated to charity. That's the place to put it, because you guys, when you receive it, it's not going to be taxed. So it's a better way to go ahead and move money over to their beneficiaries. And I think that's where, you start looking at all these tax law changes that, again, I can't stress enough that this is the opportunity for you guys to talk to your donor base as to what needs to be, how you can touch base with them and what they can do in regard to charitable giving, and just show that you care, that you want to touch base with them, that you want to partner with them, and that you do really care, and you do tell them about what the tax law. You don't have to be tax experts, but just let them know the basics. Some of the new provisions in regard to individual taxpayers. There's a tip income deduction. I don't think that really applies to any of us in the charitable area. The overtime income deduction is actually up to $12,500, $25,000 for joint filers. That will be additional reporting things that you would need to do because you have to tell the employee how much of their overtime it is. The deduction is not based upon the overtime that they worked. It's the 1/2 of that they got paid. So if they worked $10 an hour, and now they're getting $15. Their reporting is only on that $5. And that is deductible up through 2028. Next slide. As you can see, another one of their basically complexity that they added a little bit, and we'll talk a little bit more of this later when we talk about charitable giving, is the itemized deduction limitation. And that is when you're in the 37% tax bracket, the highest tax bracket, your itemized deductions are basically effectively being taxed as if it were at a 35% tax rate. So you're going to get a 35% benefit, not a 37% benefit. And again, it only deals with that higher tax rate. So and then the 529 plans, this is a very valuable tool to use for taxpayers. And then the dependent care assistance went up from $5,000 to $7,500 after 2025. Next slide.
Okay,
I'll turn it over to you, Jake.
Yeah, my first topic of the afternoon has consumed the exempt organizations examination function of the IRS for years. It's comprised the majority of audits conducted by the IRS since 2023. As shown on the screen here, we're talking about the Employee Retention Credit, or ERC, as we used to refer to it. Sarah, if you could change the slide, please. For those of you who are unaware, the ERC is a refundable tax credit for certain eligible businesses and tax-exempt organizations that had employees that were affected during the COVID-19 pandemic. It has been, to put it mildly, been rife with fraud and abuse. The most recent news release on irs.gov related to ERC noted that 460 criminal cases had been initiated as of a year ago. Those potentially fraudulent claims alone involved nearly $7 billion worth of claims. And those were just the criminal investigations. The ERC was available to eligible employers that paid qualified wages to some or all employees after the pandemic started in March of 2020 and before January of 2022. Eligibility and credit amounts varied depending on when the business impacts occurred. Generally, tax-exempt organizations and businesses that qualified were those that were suspended by a government order due to the pandemic during 2020 or the first 3 calendar quarters of 2021. They also could have experienced a required decline in gross receipts during 2020. Or again, the first 3 quarters of calendar quarters of 2021. And then lastly, they could have been qualified as a recovery startup business for the 3rd or 4th quarters of 2021. Those were less common. Again, though, eligible employers must have paid qualified wages to claim the credit and could claim it on an original or an amended employment tax return for a period within those dates. Circling back to IRS exams, the latter, those amended employment tax returns, contributed to the logjam that delayed the processing of ERC returns. IRS computer systems couldn't accept amended returns submitted electronically. So all those paper returns sat for months in piles in a processing center in Ogden, Utah. I visited that processing center during that time. It's as bad as it sounds. Stacks of returns, hundreds of thousands, just gathering dust. Eventually, the IRS devoted significant resources to scanning those paper returns and converting them to electronic form. But the damage had kind of been done at that point. There were other limitations on the ERC that made it a challenge for the IRS to administer. For example, employers couldn't claim the ERC on wages that were reported as payroll costs for Paycheck Protection Program loan forgiveness. That added level of complexity from a data source outside of IRS. The PPP was administered by the Small Business Administration, put additional strain on IRS examination resources, that were already overwhelmed by the volume of those ERC claims. So all that background gives us some context for changes to the ERC implemented by the OBBBA. Prior IRS guidance on the ERC generally allowed organizations to claim it for 2020 tax periods by April 15th of 2024, and for 2021 tax periods by April 15th of 2025. The new law states that effective immediately, ERC refund claims for the third and fourth calendar quarters of 2021 that were filed after January 31st of 2024 will be disallowed, regardless of whether the claim was timely filed or valid under prior law. It does specify, though, for those of you that did receive the refund or claim, that creditor refunds that had already been processed are unaffected by this change. It's unclear why the changes only apply to claims for the third and fourth calendar quarters of 2021, but the amended statute, which is Internal Revenue Code Section 3134, only applies to wages paid in those two quarters. In addition to those changes, the statute of limitation on refund claims for, again, those same third and fourth quarter of 2021 claims has been extended 6 years from the later of the date of the originally quarterly return due date, the original return filing date, or the date on which the claim was filed. So all this means that the IRS could be examining ERC claims until January 31st of 2030. Next slide, please. I believe Brian will be discussing the new Form 1099 reporting thresholds.
Well, first of all, the code word is 238. The code word is number 238. 238. Right, Sarah? Next slide. These are the new 1099 reporting requirements, which I think everybody will welcome. I can say that the one thing that IRS does understand in regard to exempt organizations is they understand payroll and they understand independent contractors. So if you ever get, big F, you ever get audited, they will be looking at your payroll and at your 1099s. But at least the good news is that now 1099s, 1099 MISCs and NECs basically are going up from $600 to $2,000, and that's in 2026. So 2025, you're under the old rules of $600, but in 2026, it will be the increased limit up to $2,000. And then from there will be the hard part, because now all of a sudden it's going to be index for inflation. And that will be hard to keep track of $2,030 or whatever it might be. So we'll have to see how they actually adjust it in 2027. So next slide, and I'll turn it back over to Jake in regard to the endowment tax for colleges and universities.
Okay, so the word of warning, the next few topics from my end are going to be a little, tax law and jargon heavy, but they'll have a substantial impact on affected organizations. So like Brian said, we'll start with IRC section 4968, which was also introduced as part of the Tax and Jobs Act of 2017. It imposes an excise tax on the net investment income of certain private colleges and universities. Sarah, if you could change the slide for me, please. Clearly, the provision was designed to target wealthy private educational institutions with large endowments. And effective next year, the law modifies the current flat 1.4% tax imposed on applicable educational institutions. Those, just for your reference, are defined as private colleges and universities with the following characteristics. They're described in Section 481 of the Higher Education Act of 1965. also eligible to participate in a program under Title IV of that act. They've had at least 3,000 tuition-paying students in the preceding taxable year. And over 50% of their tuition-paying students are located in the U.S. Lastly, they have a student-adjusted endowment of at least $500,000. Simple math, 3,000 students multiplied by $500,000 of endowment per student implies that the law targets institutions with at least $1.5 billion of assets. We'll discuss more of the details in the coming slides. For now, I'd note that public colleges and universities are excluded, like before. I would note that the final bill also removed provisions originally passed by the House of Representatives that would have exempted religious affiliated schools and schools that don't receive federal aid from paying this tax. Again, those were removed. Another nixed provision would have prevented institutions from including students located out of the United States. And again, that provision was also removed. If we can go to the next slide, we'll talk about some of the details. So student adjusted endowment is calculated by taking the value of the institution's assets and dividing it by the number of its students. That seems straightforward enough, but the idiom, the devil's in the details, is particularly true here, like with all matters of tax law. In the calculation, the value of assets is determined by taking the aggregate fair market value of the institution's assets, other than those used directly in carrying out its exempt purpose, at the end of the preceding taxable year, and adding the value of assets of related organizations. So there's a lot to take from that. So other than those assets used in directly carrying out the exempt purposes, seems a bit nebulous, right? But the Treasury regulations tell us they include assets held for the production of income, so stocks, bonds, et cetera, and property used for the purpose of managing the institution's endowment funds, like your office and equipment. Generally, any reasonable method that's consistently applied can be used to determine that fair market value. That number of students calculation is much less complex. It's determined by the daily average number of full-time students attending the institution. Part-time students are considered on a full-time student equivalent basis. So a student attending school half-time would be counted as 0.5 instead of 1. Moving to the next slide. So importantly, as noted on that last slide, the assets and net investment income of related organizations is included in the calculation of the institution's tax liability. For purposes of this code section, a related organization is entity that controls the institution, is controlled by it, is controlled by one or more persons who also control the institution, or is a supporting organization under Section 509A3. The latter, of course, fairly common in higher education. Control, we'll talk about for a minute. It has several definitions within the Internal Revenue Code. For our purposes, the related Treasury regulations state that an organization controls an educational institution if it owns more than 50% of the voting and non-voting stock or membership interest in it. The organization or its managers, directors, et cetera, can appoint or elect 50% or more of the members of the school's governing body. That includes the power to remove or replace them. They can require the school to make an expenditure or prevent it from making one. Required to perform any act that significantly affects the operations or prevent it, et cetera. Certain entities are excluded from that definition of related organizations. taxable entities and trusts. Idea there is to avoid double taxation. Certain lead trusts and remainder trusts, partnerships, S corps, etc. Next slide, please. Okay, so how do we determine net investment income? So it's calculated using rules similar to Internal Revenue Code section 4940C. Basic calculation has three elements: your gross investment income, capital gain net income, and allowable deductions. So gross investment income would include sources like interest, dividends, rents, royalties, etc. There's also an exclusion for income subject to unrelated business income tax under Section 511. Like with before, idea here is to avoid double taxation of that income. Tax exempt income from bonds would also be excluded there. Capital gains are kind of treated similarly. Those are generally includable here. But if they're subject to unrelated business income tax, then those would be excluded. So like we talked about on the previous few slides, an applicable educational institution should factor in amounts held by those related organizations. So while the institution can't use an overall capital loss to offset gains to calculate that income, the related capital losses among the related entities can offset it to calculate your overall income. IRS confirmed this in a notice it issued in 2018. So in addition to that traditional net investment income calculation, the following income is included: interest income from student loans made by the institution or any related organization, royalty income derived from grants or payments between any federal agency and the institution, any related org or any student or faculty member used in research and development, et cetera. The idea there is that research institutions in particular are a target of the tax. And then lastly, the net investment income of any related organization. There is a carve out for that net investment income for related organizations if it's not intended or available for the use or benefit of the institution. It can generally be excluded unless the institution controls the organization or is a supporting organization under Section 509A3 with respect to the organization. So again, potential to have some of that income excluded from the calculation. The third factor in that calculation is the allowable deductions. In general, expenses paid or incurred for production or collection of gross investment income, et cetera, are allowed as a deduction there. We'll move on to our next slide. And here we talk about the tax rates. Private colleges and institutions with endowed assets per student between $500,000 and $750,000 will pay 1.4%. That matches the current rate. Those between $750,001 and $2 million will pay 4%. And then lastly, institutions with over $2 million of endowed assets per student will pay the highest rate, which is 8%. The original proposed high rate, I believe, was around 20%. So this is quite a bit below what was anticipated originally. I would note that the law explicitly instructs the IRS to prescribe regulations or other guidance to prevent avoidance of the tax, specifically through restructuring of endowment funds or other arrangements to try to reduce the value of net investment income or assets subject to the tax. Because of that high profile nature of this legislation and we'll say other ongoing matters related to higher education, institutions should prepare for future IRS exams or other measures aimed at evaluating compliance. So how many organizations do we think this will affect? I know internally, IRS estimated that the original tax that went into effect in 2018 would apply to 40 or fewer schools. Current consensus seems to be that 30 or fewer institutions are expected to meet the relevant thresholds. And then let's see, one last note here. There are additional reporting requirements in the legislation, specifically any institution that has to pay the tax will have to report the total number of tuition paying students taken into account, and then their total number of students on the Form 990. Next slide, please. Okay. Next, we have the expansion of the tax on excess compensation. Next slide, please. So like with the endowment tax we just discussed, Code Section 4960 was enacted as part of the Tax Cuts and Jobs Act. It imposed on applicable tax-exempt organizations, or we'll sometimes refer to them as ATEOs, and related organizations, an excise tax that matches the corporate tax rate under Internal Revenue Code Section 11. That rate is currently 21% and has been for a few years. So it imposes that tax on, again, excess compensation defined as annual compensation over $1 million paid to a covered employee, and excess parachute payments, which are certain large payments made contingent on an employee's separation from service. ATEOs in general include 501c entities and certain governmental entities. Like with the endowment tax, related organizations are generally defined as entities that are controlled by or otherwise affiliated with an ATEO. Some more sort of definition stuff. Covered employees originally included only the 5 highest paid employees in any given year, including those paid by related entities. So beginning next year, the OBBA expands the scope of this tax. So under the new law, the tax will now apply to all employees and former employees whose compensation exceeds $1 million during the applicable tax year. Additionally, the look-back period for former employees is limited to taxable years beginning after December 31st of 2016. So we have a little bit of a look back there. So just for some quick background, compensation includes all the stuff you think it would: wages, bonuses, deferred comp. There are some exceptions. Excludes Roth contributions, qualified retirement plan payouts. Interestingly, there's also an exception for compensation paid for direct medical or vet services. So if a professional performs both clinical and non-clinical duties, the organization can reasonably allocate compensation between those services. I obviously recommend maintaining contemporaneous detailed written records to support that allocation there. The final piece of background here, the parachute payments, just quickly, those are payments that wouldn't be made but for an employee separation. If the total present value of those payments exceeds 3 times the employee's base compensation, then the excess is subject to the excess compensation tax. Brian?
Yep. Next, we'll be talking about the charitable deductions for itemizers and non-itemizer. Next slide, Sarah. Code word is 921. 921. 921 is the code word. Next slide, Sarah. Beginning in 2026 for charitable deductions, for people who do not itemize deductions, they are now allowed to take a above the line deduction of $1,000 for if you're an individual and $2,000 for joint filers. So basically now starting in 2026, not 2025, but in 2026, people who do not itemize can still make charitable contributions, which I think is a big plus, and is something that we as charitable organizations should be informing our donor base that there is this opportunity in 2026. May not do it this year, but at the early next year, that there should be some type of notification to your donor base that there is this possibility of them getting a charitable deduction. Now, again, the way the IRS has been working in regard to making these special accommodations for charitable contributions is that these must be made to public charities. In this case, it must be cash, and it must be to public charities, not donor advised funds, not supporting organizations, and not private foundations. And again, I put on there at the very bottom, basically for 2025, and then going forward on a going forward basis in 2026, index for inflation, you can see what the standard deduction is. So there's going to be a lot of taxpayers out there, a lot of people in your donor base who could be receiving a charitable deduction for the money that they have provided you guys. So make sure that you notify them and you let them know. Next slide, Sarah. The two things that make it a little bit more complicated in regard to it is this new floor on charitable deductions for itemized individuals. Individuals who itemize can only claim a deduction only to the extent that the total contributions exceed 0.5% of their adjusted gross income. So what they're doing is they're taking a haircut. Certain amount of the charitable contributions that you make are not going to be deductible. So if you look at it from a taxpayer who has an AGI of $400,000, 0.05 of the amount times the AGI is $2,000. Anything above $2,000 can be deducted. The stuff at $2,000 and below will not be deducted. So this starts in 2026. So again, the first thing that sometimes you look at it and you say, what do I tell my donor base is, hey, starting in 2026, you guys are going to get a haircut. Maybe we should accelerate donations into 2025 and let them know that, hey, tax rates are the same. Is there a possibility that I'm already itemizing deductions? Can I go ahead and get more contributions in 25? Next slide, Sarah. One of the good news in regard to it, they now make the 60% of your AGI limit that can be done to public charities instead of reverting back to before where it was 50%. So that's now permanent, and that just helps because now they don't have to worry about it being expired, doesn't have to worry about going away. They can go ahead and do the money, make the cash contributions that they want in order to take advantage of the 60% of the AGI. Next slide, Sarah. The other thing that makes it a little bit more difficult is that you can see that there's a 35% cap on the value of the itemized deductions, including charitable contributions. So that's right in there with you. And starting, there's going to be that new SALT deduction and everything else. So all those deductions are going to be reduced to 35%. It can't be greater than that. So if you're in the 37% tax bracket, you'll only get 35% as if you were in a 35% tax bracket as a deduction. So an example here is if you have $100,000 of itemized deductions, the maximum that you could take is actually $35,000, not $37,000. So you're losing $2,000. Again, another scenario of something that is negative into regard to charitable giving, letting people know that, hey, if you accelerate them and make it in 2025, you'll be that much better off. This limit kind of takes care of the P's limitation that they had before. Next slide, Sarah. And as we kind of talked about, consider accelerating contributions into 2025 before these new rules, because you look at it and what do you have in charitable giving? Well, first of all, non-itemized, we can now make a deduction. Itemized people are now taking a floor there's a cut on the floor. And if you make a lot of money and you're in a 37% tax bracket, you're going to lose even more on the deductions. So basically, if you look at it, if you're going to give a lot of contributions and you're going to be high in the itemized deductions, try to be in a 35% tax bracket. Don't try to be in the 37% tax bracket. Same deduction, it's just that you have less income. So now you're at the 35%. Considering budgeting contributions, that's what we talked about back in 2018. And you can actually look at what's happened here on this floor. Again, the AGI of 400,000, 5%, you're going to lose $2,000 deduction in 26. If you do the exact same thing in 2027, you're going to lose $2,000 in itemized deductions. So what happens if your AGI and you just give all the contributions that you gave, you do it all in 1 year, you only lose $200,000 once, not twice. Next slide, Sarah. Donors make large gifts on the 31st we talked about. And the big one, I can't say enough about qualified charitable distributions from IRAs. If you got a donor base that's age 70 and a half and older, there's a lot of benefits that can occur when you're actually doing qualified charitable distributions from the IRA. And because it helps so much more, it reduces your Medicare premiums, and I could probably talk about an hour of all the benefits that QCDs actually provide the donors. Next slide, Sarah. Charitable deductions for corporations. They're also put a floor in there as well. Next slide. Basically, there's a floor that says you contribute at least 1% of the taxable income. Basically, it's still at 10%, but they take that 1% and you can't deduct it. So whatever you give, that 1%, 1/10 of your contribution, if you match the 10% limit, you can't. That will be disallowed for this year. It'll be carried forward, but it will be disallowed. So again, it's another floor that makes it a little bit more complicated in regard to charitable giving on a going forward basis. Next slide. One thing to do there is to consider whether you're a C corporation. This is not what you can do as a charity or anything in that regard, but you can at least bring up the idea and let their own tax advisors come up with this strategy, which is basically consider deducting the expense as advertising or promotional expense rather than as a charitable contribution, that there is no donative intent. That happens a lot. If you look at it from the sponsorships that you guys do, that when you go through the sponsorship rules, that a certain dollar amount will be considered charitable contributions. Many of those corporations or businesses will go ahead and just deduct it as a promotional expense and will not consider it a charitable donation, and therefore won't be subject to the rules. Next slide. Okay, Jack, turn it back over to you.
Okay, this is the final topic on our agenda. Next slide,
okay,
please.
We're pretty close to time, so just so you know.
We are. Before we do that, code word number 3, actually code number is 136. Again, that's 136. Give them a few more seconds and then we'll proceed. That number is 136. Okay. Like Brian said, we just have a few minutes left, so we'll go through this fairly quickly. So this is actually a new income tax credit created by the legislation. It's for individuals who donate to certain code section 501c3 organizations that provide scholarships to U.S. elementary and secondary school students, basically your private schools. It's a dollar for dollar credit, meaning every dollar donated reduces the donor's federal tax liability by the same amount. It's capped at $1,700 as shown here, but it is non-refundable, so it can reduce your tax liability to zero, but not result in a refund. your contributed amounts also can't be double counted. In other words, you can't claim an amount for purposes of the credit, but also as a charitable contribution. The idea here is to help private school students who are members of households with an income that's not greater than 300% of the area median gross income. There is a 5-year carry forward period, and the credit is reduced by any state tax credit amount for those same contributions. And then lastly, it will be available beginning in 2027. And we'll find out here in just a minute why it's going to be a few years. Next slide, please. Okay, so as noted on the other slide, recipient organizations must, among other requirements, be Code Section 501c3 organizations. Here's the important part hinted at on that last slide. They must be identified as qualifying scholarship granting organizations by a state. In effect, that means that states must opt in to the provision for the credit to be available in their states. We've actually seen a recent example of this in North Carolina, where the governor vetoed a bill that would have established the program. Legislators in the state voted to or have a chance to actually override that veto later this month. So as of yet, we don't have a state that's opted in, but it seems like that we could be close. These organizations must also provide scholarships to 10 or more students who don't all attend the same school. They must spend 90% of their income on scholarships for these eligible students. Scholarships must be limited to qualified elementary or secondary education expenses, and then they can't earmark or set aside contributions for a particular student. So you're looking at not starting until 2027. That gives the 501c3 organizations some time to either modify their existing activities or establish new organizations, and that gives states time to opt into the program and create it on a state level. That is the end of the presentation from a slide perspective. As I understand it, with any remaining time, we'll answer any questions that you have.
Yeah. And I think too that, if we don't get to any questions, please, this is our contact information. Please contact us. I mean, whatever questions we have that haven't been answered, we will reach back out to you.